From the morning reading, the Q's another new high. Qualcomm drops on Apple suit. Breadth strengthened compared to the prior session as advancers led 1628 to 1357 on the New York Stock Exchange and decliners led 1642 to 1143 on the Nasdaq. On the S&P 500 snapshot, a modest loss on Trump's first full business day in office. The S&P 500 reacted to President Trump's first full day in office with a morning sell-off to its negative 0.63% intraday low just before the lunch hour. The afternoon saw a modest rally in a couple of waves to its trimmed closing loss of 0.27%. Elsewhere, Asian markets were mixed, with the Nikkei dropping 1.29%. European indices closed more uniformly in the red, with the European Stocks 600 down 0.43%. The general meme on financial websites was concerned over Trump protectionist policies. Big gains in earnings are on tap. According to Standard & Poor's, companies in the S&P 500 should earn 33% more in the fourth quarter of 2016 than they did the same quarter of 2015. That would be the best growth in years, which is taken to be a good sign. But when earnings growth has been high, when stocks are already sitting at all-time highs, those future gains are muted if they exist at all. Big tech has been doing well. The Nasdaq 100 index, dominated by large tech companies, just ended a streak of 10 straight days of outperforming the S&P 500. The index managed that kind of dominance only a handful of times in its 30-year history, usually leading to further outperformance in the weeks ahead. Volume not following price. Thanks to weakness in stocks like Qualcomm, BAC, and GE, the up volume on the New York Stock Exchange was only 40%, while the up issues ratio was 55%. When stocks were within several percent of their 52-week high, such negatively lopsided volume led to a positive return in the S&P 500 over the next 40 days only once out of 8 occurrences. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:19 a.m. Mountain Time, and I'm recording this in preparation for the market day of January the 24th, 2017. Full disclaimers are at the end of the video, but beware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and bounce over to the morning report. And it's time for this cut. We had just a little bit of softness. We had the S&P futures were down a few points, a little less than scratch. Russell futures down about a third, NASDAQ futures down about a quarter, and Dow futures down just below scratch. Crude oil down about 1.2%, euro up about a quarter of a percent, bonds up just above scratch, and gold up about 0.75%. And overseas action, you have China up just above scratch, Hong Kong up just above scratch, Nikkei from Japan down about 0.5%. The DAX in Germany up about just over scratch, and the United Kingdom just above scratch. In macroeconomic reports for today of the United States variety that are significant, you have existing home sales, and that will be during market hours. And that looks to be about it. Looking forward to tomorrow, you have crude oil inventories, the weekly report. And that looks to be about it. So we continue to have kind of a light start of the week for the macroeconomic reports. Current volatility conditions, short-term VIX did move up a bit yesterday, 10.92. Skew also eroded a bit from its very high levels and is down to 137.78, but is still very elevated and in warning status. IV percentiles are all exceptionally low. Looks like we got a bad number there. Sorry about that. S&P at 13, the Russell 14, the NASDAQ in an 8, and I'm sure the Dow is still in the lower quadrants. Let's see, on standard deviations, on a close-to-close basis across all four of the U.S.-based indices, there were no standard deviation size moves yesterday, and you can see we've been really quite quiet here. Normally, the S&P, you'd have 4 standard deviation size moves of various varieties in a 2-week period, and you see we have 1. We have none on the NASDAQ and on the Dow at this point. Russell, a bit more activity, but it usually does. So very quiet across volatility parameters that we like to look at this time. Let's go ahead and take a look at the daily chart. Okay, we're at the S&P futures, and of course we've had this pattern of late that has been mostly one of sideways consolidation, but it does appear now that as we take a look at this shorter term pattern that we're starting to get something of a triangle. Now we should have about a 70% probability that this triangle resolves to the bullish side given the pattern in which the triangle set up. It was bullish coming into the pattern, and we would expect that it, with a higher probability, would exit to the bullish side. You have all kinds of support below this, including the cloud. Though if we were to get a retracement, there is obviously some room. If you go back to the very long-term wedge pattern that's been forming, we could have a drop down here, perhaps down into the 2180 area. So that would be a drop of about 80 points is certainly within the realm of the overall larger bullish patterns. Not really expecting that. That's about a 1 in 3 probability that it would get anywhere in this area. Much more probable that we're going to come back up and revisit the former highs. Now let me extend this line here. And one of the things I want to point out is that if we get a new high, if we still maintain ourselves within this pattern, it's likely to be another incremental high. So we might get up here to around 2,300, but to see some sort of huge Fibonacci extension kind of size move doesn't seem to be in the pattern at this point. So we're kind of in a situation where the bias looks bullish, but the opportunity looks limited. So you just kind of keep all that in mind. It's not the easiest thing to be taking a lot of risk right now, even though we've got a bullish bias. We do, in the bigger picture, continue to get these incremental new highs and incremental higher lows, and yet at the same time, it's taking a lot of time to get to those new highs. And if you're using options or any kind of swing trading kind of methodology, you probably aren't giving yourself enough time for what looks to be what the patterns might be telling you. Also, on the Dow futures, we seem to be seeing, the slight downward drift. You might be pointing this into a wedge pattern at this point, and that wedge pattern again would be expected to break to the bullish side. So again, tough patterns that have been we're setting up in terms of where we might go if all this sideways consolidation. But there are some things that are starting to show. Now, the NASDAQ looks a lot more toppy here. You see all these little small bodies of late. Look at just how small this has been all week. Now, we keep getting new highs, and each one of those new highs is bullish in its own character. But you see the wicks here, and in a number of cases, we've got tall wicks on both sides. You see, most part, these are either doji or spinning tops. And so far, a spinning top forming for today. If you look at the big 5 components of the NASDAQ, you've got Apple. Apple, of course, has a long way to go just to get back to its 52-week high. It has been bullish in the short term. Amazon, still has some room to go just to get to its 52-week highs. We continue to see this across these big tech companies. So it doesn't seem like the top is in yet because these have got room to go just to get to their 52-week highs. Here's your third big component of the NASDAQ, and another one that has some room to go just to get to the 52-week high. Forget about making new highs like the overall index. You have Tesla. Also, look at this. A lot of room to go to get back to its new highs, even though the short-term pattern has been one that is clearly quite bullish. And then finally, Netflix. Netflix has been stronger than the others, but of the ones that we showed, Apple, Amazon, Facebook, Tesla, and Netflix, 4 of the 5 had significant room to go just to get to their 52-week highs. Only in the case of Netflix, and of course you had the big successful earnings report a few days ago in that one that drove it up to these current high areas. In terms of the Russell, probably have a complex bull flag forming here. Still looks to be primarily one of kind of sideways consolidation, and anything that's within this box is probably just noise. We could see a retest of the short-term low, but at some point we probably are going to see a challenge of that 1400 area. In crude oil, you see again this kind of complex consolidation pattern, probably a complex bull flag or something of the similar. We'll see if this starts to perhaps set up. We could probably start to put something of a triangle on this at this point. If we do put a triangle on this, again, the pattern coming in was bullish. The expectation, much like the S&P chart, would be about a 70% probability of a resolution to the bullish side. Lots of support below, only about a 1/3, 1 in 3 probability that you're going to see anything down into this area versus something that's probably closer to 55, 56. And then gold. Gold, of course, has been one that has just bedeviled technical chartists for the last year or so with its history. And we'll take a look here. See this history of a breakout and then coming back and kind of retesting an area that would seem to be lower than it should go, and then move back up, and then a breakdown, and then now we've been in this really pronounced intermediate term pattern to the downside, and then this huge kind of persistent without any retracement what would seem to be a counter trend move, but the counter trend move has been really robust, and then this has been going on for a month now, and nary a swing to the downside of any note, and all the way up into the cloud now, more of a neutralized stance at this point, given how far it's gone. But it's hard to believe that we actually see, this move up into the 1350s and 1375s and 1400 areas with this kind of a pattern. But then we remind ourselves that gold has just been this kind of a mess on the technical charts of late. So just kind of keep that in mind. If you're trading in gold, should probably be very speculative and position size accordingly. Now, of course, much of this, and we'll take a look at bonds in just a moment, is all related to what's going on in the dollar, and a lot of factors influence the dollar. And, certainly part of that of recent is what's happening with the presidency and changes in policy. Of course, you had the big bear and the intermediate trend on long bonds, but that also had something of a pretty pronounced counter trend move though that seems to have behaved more like we would expect it to. Counter trend move, running into resistance and starting to break down. At this point, we would seem to have had a higher high, a higher high, a higher low, but now a lower high would seem to be in place at the moment. So we'll see if this is just a complex consolidation pattern and then eventually resolves to drop below the 147.9 30 seconds area. And this is just, nothing more than noise in the bigger pattern. But both gold and bonds have been certainly very interesting to watch of late. And then finally, we'll take a look at volatility, and you see we've been chattering here right into the low area of the last 2 years. And I've started showing you a little bit more of this 2-year perspective because some of these charts are starting to form very, very long-term patterns that may be coming into play and tell us a little bit about what to expect on this short-term consolidation. But you see the VIX is currently running below a 12 once again, so more of this very, very low range of volatility. So that should be enough on the charts. Let's go ahead and go to the daily report. We continue to see a lot of kind of choppiness on our various indicators here, very much as you would expect, given that we've been in a persistent state of consolidation for several weeks now. Intermediate term phase opinion, currently market phase 5. I would give this a very weak 5. This thing has been kind of basically oscillating between the edge of 5 and then perhaps, signaling something that would be more bullish. So we've had this kind of break of diagonal support, not really of the break of horizontal support yet, but giving you kind of a weak signal there. Now on the market timing signals, these have been more consistent in that they're still with that bullish bias. The first mechanical signal coming to us from IBD, confirmed uptrend, that's bullish. The second one, GMI index, 5 out of 6 buy signal in place since 11:10. And then the stock charts decision point scoreboard, no change from yesterday. Still the mixed signals on the short term and the mixed signals on the long term, with consistent signals on the intermediate term. Overall consensus of the market timing signals is to the bullish side, albeit a choppy and weak one. Portfolio position sizing opinions, both models coming in at 100%. Intermediate term market posture, still the S&P is holding on to that exceptionally strong bull, but we see this kind of slow motion erosion. And if this drops below an 80, like the Dow and already the Russell do, that would drop us into weak bear. That, however, has been supported by an exceptionally strong bullish sentiment line. That's a longer term indicator. So the expectation of bearish activity is expected at this point from a probability standpoint. Obviously, new news, things can kind of build on themselves, but from a probability standpoint, any bearishness would expect it to be relatively shallow. Now, the Dow's already dropped into weak bear. Also should note that the Russell has dropped into strong bear. So definitely we're seeing some breakdown and contrast between the 4 indices. And you've got the NASDAQ perhaps as the strongest, followed by the S&P, then the Dow, and then the Russell being the weakest on the bearish side. In terms of the hedge warning status, we're still at 0+, normal with some elevated conditions. Option income strategies, we have been kind of putting an asterisk to this. It's technically, this is below the acceptable range to initiate new positions for novice traders in the option income strategies. Anything below a 12 becomes questionable because your premiums are so low compared to the risk that you're taking on, and for novice traders that can be problematic. But this has been oscillating right here around 12, and one day you're above 12, and one day you're below 12, and then back and forth. So we're kind of putting a bit of an asterisk by that and just kind of noting that. In terms of the volatility-based specific indicators, we continue to see these warnings about, an expected expansion in volatility at some point. Distribution day count on the NASDAQ continues to be elevated. We're currently at an 8, though the S&P did drop out of warning status. SKU also dropped some, so that level is a little lower. On the trend-based area, we still have that kind of mild warning from the market phase 5, just barely being in place. We do have all 5 of the risk aversion indicators currently in the risk off posture, though there is some signs of rolling up being shown in some of those indicators, so we'll continue to watch to see if we get changes in those signals. Sentiment is about as neutral as it can get. From a sector-specific performance, you see nothing terribly strong. A couple defensive sectors, real estate and telecom, led performance yesterday, but then you had a couple risk-on. Materials and consumer discretionary were also following up in the 3rd and 4th place. In terms of the worst performers for the day, clearly energy, followed by industrials and financials. So really not a day in which you could break this down as a risk on or risk off day. Not a clear pattern between those groups. Also not a clear pattern is market posture by sector, by time frame. And if we focus on the short to intermediate term, you can see there's not a lot of sectors that are, robust for sure. Consumer discretionary and consumer staples seem to be holding up a bit better. Industrials, materials and technology, especially technology, has been probably the best sector of late in terms of consistent performance. Now, the worst one continues to be healthcare. Healthcare continues to be very, very difficult place to make money on any kind of broad base at all. Now, you can break out biotech versus other components of healthcare. Perhaps you can find some spots of bullishness, but in general, healthcare continues to be an area to struggle. And you see the 1 month, this is the area we've been focusing on given this sideways choppiness. And you got a couple sectors that are nominally above 2% performance and a couple nominally in that 2.5, 3 plus negative performance. It's starting to widen out perhaps a little bit more than what we were seeing in the 1 month standpoint, but we're still seeing, not a lot of progress in a consistent way by anybody. Perhaps information technology being one of the better places. Materials and real estate actually have been also perhaps a bit more consistent over those time frames. But those stories, real estate, materials, technology, those are not the typical leaders, and the combination of those three, nor would you expect to see in terms of worst performance telecom, utilities, mixed with financials, industrial, and energy. So this is really, really messed up and choppy with no clear trends in terms of risk-on performance or risk-off performance. Probably corrective action from overshoots and the rotation that took place coming out of the election. So probably enough for today. Let's go ahead and get this to publish. I'm going to go ahead and scroll through these. If you see something of interest, just hit the pause button, and I'm going to get to the disclaimers. Disclaimers, as always, hit the pause button if you need more time to read the disclaimers, and then also note the hyperlink down here at the bottom that'll take you to the full set of disclosures. We'll see you back here tomorrow morning for the next market preview from Falcon Global. In the meantime, manage that risk profile. Go out there and learn something about your trading every day, and everything should start to fall into place for you. Good trading.